Welcome back to the show. I have again the pleasure to have Martin Tixier here. We haven't been recording a video for probably a month. It's also due to my holidays. A lot has changed in 1 month, and we will discuss the whole financial market implication and some key topics together with Martin. Hi, Martin. Good to have you back.
Glad to see you, Zoltan. You look nicely rested and tanned. Good to see that you had a good break. And so many things have happened. So many things have happened.
It was also necessary. One more month, but the war in Iran is still ongoing. And I think that was also the topic of your recent research report you have published, the Sicilian Expedition. Can you elaborate a bit on that?
I wanted to continue on the theme with like some vibes from classical history because, as I mentioned before, one of our conversations was called Crossing the Rubicon. But as well, I used the Sicilian Expedition because if you take into account the Thucydides trap, which has been mentioned by Xi, and the War of the Peloponnese, there was at the time around 400 before Christ, Athenian expedition towards Sicily, which was a total disaster, which led, in fact, to the fall of the Athenian democracy, which was briefly replaced by an oligarchy power structure. And there's some eerie similarities with what's happening in the United States, because it seems that the adventure of the Trump administration in Iran hasn't been such a success like Venezuela was. And as such, we're seeing still very significant pressure on oil prices and dwindling stockpiles when it comes to distillated products such as diesel, jet fuel. And it seems to us that we're seeing like dwindling US reserves. So we're coming very close to the critical point where we're going to see significant damage from that situation. So that's why I use the Sicilian expeditions, because the consequences of these expeditions towards Iran hasn't been the same success as for Venezuela. So we're coming to the point that we're going to see some serious pain. We're already seeing some inflationary pressures in the latest macro releases, from CPI to PPI. We're starting to see unfolding, as you mentioned before, Zoltan, the possibility of seeing a second wave of inflation coming into play. And I've used as well the Sicilian Expedition because as well it was mentioned that President Donald Trump is thinking about having a dollar note of a $250 bill with his face on it. And it hasn't happened since at least 120 years or something like this. When you think about that, United States is about to celebrate its 250 years of history. It seems that we have a lot of signs of like some kind of dwindling U.S. empire unfolding in front of us. But what I wanted as well to ask you, because you've been away for quite some time, and I've seen that you've been very active in various parts of Europe when it comes to real estate. We're seeing with inflation, as we mentioned in our previous conversation, rise not only of commodities and the cost of material, but as well rise in the cost of capital. Where do you see the pain and where do you see the opportunities on your side of real estate?
Very interesting. If you look at the European real estate cycle, we are already in 4 years in a bear market, actually. So that's quite a long period. That's longer than after the GFC. And just to look at it, I think currently you cannot go away without actually interest rate increases. So the market is pricing probably around 50 basis points of increase from the European Central Bank. The inflation wave is still ongoing, although we have in Switzerland again, we had quite good inflation data this month. The inflation did not increase further. Year on year, we're just at 0.6%, but in Europe, we are at 3.2%, yes. I think. If you look at some countries like the UK, you have now financing costs, probably you have the highest financing costs probably in like probably 20 years. I'm certainly, I like valuations in real estate. And I think if you are like a 5 or 10 years horizon, real estate will come back. But I think I am still one of those who think that cap rates could still move out actually this year. So I don't see any other possibility. Some people are saying, yeah, it is the financing costs are better because banks are trying to put more money at work, but I think it still create an upward pressure on capitalization rates in Europe. So if we look at Europe, probably the regions I'm more optimistic is Scandinavia, which has on the energy supply a better setup than Germany. Germany is currently again, it's actually a government failure, a policy failure in the clear policies of the French are in that context a bit better. But it's also interesting if we talk about France, and I also listened to some podcasts on the French real estate market in French, and it's interesting that the financing costs for homes in France are at around 3.2%, while the bond yields are higher. It's quite an aberration, actually. What I think that the banks are keeping still the financing costs for homeownership lending down. So I've been following some of the French podcasts, so still trying to understand a bit better French as well. So the opportunities are still there, and the opportunities are, I think, if you look at capital raising, Southern European like Stone Shield, Azora, they're doing quite well on capital raising. They're usually oversubscribed, so the money is piling in really also more still to Southern Europe, to the hospitality sector, student housing. So
yeah, like we mentioned before, hospitality in Southern Europe being the place to be. If you look at as well the transportation data, it looks like the number of tourists are flocking again in Spain, in Portugal, in Greece, and there's quite an important traffic towards Southern Europe, hence the defensive play of being in hospitality. What about industrials? Do you see any value in industrials?
I think I do see, like in industrial real estate, like logistic real estate, but we still have an oversupply still in Europe. Um, but the whole defense spending, some people think that could also be positive going forward. But I think the vacancy rates still need to come down. They have increased over the last 2 years, but have ticked down a bit by a half. It increased to around 5% and was lower, now came down again below 5. So I think in Germany, I like the valuation some of the logistics properties, but you need also to have the right setup, also the energy infrastructure also in place. And where a lot of money is still piled in and everybody is still bullish as hell is the data center market.
Yes.
But I having also my question marks there, whether that will not end up in tears. But let's see. So, but coming back to other like topics also outside of the Iran crisis and Europe, can you give us a bit an update also on the private credit market? What did happen over the recent time?
We're really seeing, as we mentioned in our previous conversation, I really think the credit cycle is turning. We're seeing a lot of signs, such as the pain in private credit is still ongoing. As we mentioned before, when there's some issues in private credit, doesn't mean that all private credit funds are in distress or are not performing, but you have some form of contagion. Which explains all the redemption requested getting by the very big players. The latest one being Blackstone getting the 45 billion Blackstone private credit fund, which is one of the largest, getting a significant request for redemptions, which is putting additional pressure on the whole sector, and the whole industry has been plagued by this redemption request because of the nervousness of investors. You have the likes of Apollo Global Management, KKR, RS, to name a few, which have all capped redemption earlier this year, which we mentioned before. We also mentioned, as you said before, the pressure coming from data centers, because there's a lot of announcements that has been made, but in terms of completion, well, enthusiasm has to be curbed because a lot of projected projects has been canceled in the US, given
I
the
remember
yeah,
you have pointed it out that some of the US data center actually relying on Chinese
absolutely.
rare earth and other components, and people are totally disregard this risk. I think going forward, everybody is piling in money to the semiconductor index. How do we see that? The whole, if you look at the semiconductor, it went up probably more than 70% in just like 1.5 months.
I think
Um,
there's the big issue is the current valuations are very dizzy. What I indicated in my latest conversation in my last post was the issue with the token value. Uh, we're if we're talking about like the devaluation of the US dollar in similarity to what has happened with the denarus currency during the fall of the Roman Empire, I think that the valuation of the tokens, which underpin the valuations of the big hyperscalers AI players, has to come down because you have the likes of the chief operating officer of Uber has mentioned that they've burned their token budget in a couple of months and the price of token is too high. So the value for money in the AI space is, I think, over enthusiastic. As such, I don't think that the current market valuations reflect the fact that the value of the token has to come down. And talking about value of tokens, we've seen some pressure coming on Bitcoin recently. Bitcoin is facing some kind of winter moment because the value of Bitcoin has been coming under significant pressure. And for me, I don't know if it's the case for you, but Bitcoin is a liquidity indicator. And it shows me
Absolutely.
that liquidity is under pressure, capital costs are rising. So maybe the upcoming IPOs might be marking the peak of the market.
And those IPOs, they will also draw away some liquidity from the current names,
Yes,
certainly. If
absolutely,
they are
absolutely.
gigantic, the floated part of I think the traded part of SpaceX is just small. He actually wants to squeeze the price of it. Probably that's his strategy, but it will anyway. It will draw away liquidity from the current market.
Yeah, and this is why you had a giant equity issuance coming from the like of Alphabet, Google coming into play. So that's a significant move because we're not talking like small equity issuance for the guys like Google. It's $80 billion. So the money involved is very, very significant.
But you don't see on the credit side like that spreads are moving out yet.
I'm already seeing signs that the market is really under pressure. We mentioned before
Okay.
that high beta, such as triple C's in high yield, have been underperforming on a total return perspective year to date, the single Bs, the double Bs. What I'm seeing right now, which for me is a sign of the credit cycle really turning, is you're seeing rising dispersions, both in equities as well as credit, but you see a very significant rise in dispersion in the loan market in the US when it comes to triple Cs. So we're already seeing the weaker part of the credit market coming under significant pressure, like private credit, subprime credit lenders, as well as triple Cs. Why? Because as we mentioned before, inflation increases the cost of capital. We've seen sovereign yields going up, and this is repricing everything. So the weaker
Yeah.
players in the triple C space are facing significant headwinds when it comes to credit availability, which is the most predictive factor to upcoming increase in default rates.
Yeah.
And
No,
when it comes
absolutely.
to default rates and cost of capital, what do you make about the upcoming refinancing wall some people are talking about in the real estate space, for example, in the US? What's your
No,
view on this?
it's quite a good question because if I look at some private funds in the market, they have quite some refinancing like in 2027. So I think that's a risk not to underestimate. And actually, everybody is now praying that Scott Bessent and also the new Fed chair are somehow could rein capital costs down. And what we need really to ask, will we um, get into some measures of financial repression in the US? You know what they're doing. You mentioned the Sicilian expedition.
Yes.
So the norms are changing also. I'm not sure what they will do, because you have on the government side, you have pressure. You will have and Scott is also quite well connected to Wall Street, as we know. So some will have problems with refinancing. I looked even at some funds. Some CMBS are coming due next year, so some big ones. So I think it's a risk not to underestimate.
Do you
But it's
think it's
yeah.
already priced, or the market is ignoring the risk?
Usually the market always thinks it's pricing it until the risks are coming due. We know that. We know that also from Switzerland on the real estate side. That's a bit different topic. But the question is, will really in this higher inflationary wave, will the Fed and the Treasury be able to bring down this capital cost? So I'm not so sure, but they will try, of course. So I think it's something which we need certainty to follow. But what I also want to point out, for some sectors like the US multifamily, I'm quite now bullish, because you can then pick up some interesting opportunities. So I think supply is now coming down. So it's not such a bad moment to get into that sector.
The issue I'm concerned with is that no matter what Scott Bessent or Kevin Warsh wants to do, when it comes to the long end of the US yield curve, unless they rein in the spending, they're going to have difficulties in taking the 10-year yields down. And I don't see with the current trajectory of the US budget deficit, how they're going to manage to impose this kind of financial repression you mentioned.
How would you recommend investors to hedge in that environment? Should they go long again, energy, gold? Uh, what would you actually recommend?
Well,
Because these risks are imminent,
yeah,
actually.
because in a stagflationary environment, you're really impacted by rising bond volatility, and as such, if you are in U.S. investment grade, for example, I would still recommend being in the short end of the curve. The 1-3 year bucket is quite protective. When it comes to high yield, I think the U.S. high yield is way too tight. I don't see any appetite to go into U.S. high yield at current spread levels. It's way too tight relative to U.S. investment grade between the both credit buckets. I would recommend as well international diversification, as I mentioned before. If you look at Brazil, for example, you can pick up some bonds paying some very, very significant coupons. If I take, for example, the current central bank 10-year rates in Brazil, it's around, I don't know, it's around like 14.3%, when inflation is around 4.5%, 5%. So you have like net positive yield coming from the exposure. And you don't have like convexity risk like you have with US investment grade. So as such, playing some exposure to international bonds from issuers such as Brazil is a way of mitigating the risk coming from exposure to stagflation and fixed income. I would also recommend having like international diversification out of the US, because of such a big level of concentration risk in the US stock market. If I take the S&P 500, the hyperscalers, the Magnificent Seven, the US stock market is way too exposed to the tech sector, which is priced to perfection. And if I look at the credit sector in the US high yield, you don't have any dispersion in the tech sector, which for me is a big, big red sign, because you should have at this stage of the credit cycle some dispersions, which you are seeing in other sectors in US high yield, for example. You don't see any dispersions currently in US high yield in the tech sector, which for me is a sign that it can't be that perfect.
Yeah, the casino is still going on, as we see in
Absolutely.
some names. Also, the betting market is going on. So that is still ongoing, and the question is, yeah, when will really the liquidity turn? And with, as you mentioned, with Bitcoin, we have a canary in the coal mine, which is singing already.
Yes, and Triple
Or
C's as well
yeah,
is telling you that high beta is not in a good shape as it was previously. So it's fading. High beta is fading. Triple C's performance is fading. As such, I would be more and more playing defense, playing into very solid cash flow generating businesses. I would go into low P's, even in low PEs international equities. I suggest looking at some frontier market where you have some very, very decent protective value with decent dividend yields, where you have like a decent price earning. I mentioned before that I'm looking at like a Georgian Armenian bank such as Line Finance Group. I'm looking at Alik Bank in Kazakhstan because they're trading very cheap, so the downside is less significant than being exposed to overpriced some overpriced tech US names, for example. So I think it's really a question of being much more active when it comes to credit and equities in terms of management. And now it's much more an issuer story than buying an index.
very well. I think that's a great final comment, and people who want to get your content, they can read it and subscribe to your Macronomics blog, which is on Substack. You want to add anything on that?
Well, I think that when you see such levels of assets under management in money market, as well as such a level of cash within Berkshire, it tells you that, like, yes, uh, the market is a little bit priced too much to perfection, and I think it's time to start to be a little bit more cautious because I see that the valuations are really, really strong right now in many
You
parts of
know,
the markets.
I see the same. So I'm managing my own pension fund. I currently have a cash quota of 51%. And so I'm also quite cautious, but so far I was a bit too cautious. The market is still running.
Yes,
And
absolutely, it is. But if you look at allocation in terms of cash, if you look at the Bank of America most recent survey, cash levels are pretty low, which is not
mhm.
it's always a contrarian sign. When people have a too small of a cash buffer and everyone is overexcited and the greed level is way too high, I think you have to start to be a little bit more on the cautious side.
Thank you very much, Martin. And we will do it again more frequently.
Absolutely.
And then love to have.
Thank you, Zoltan. Have a great day. Bye bye.